Next up on stage, by the way, is a gentleman who tomorrow, I'll tell you where he's going to be tomorrow before I tell you what he's going to be doing today. Tomorrow he's doing a 45-minute session over at the Block stage, which is in that direction for about 5 minutes. So you'll probably see me over there or over here. I'll be my twin over there, my digital twin. And that's going to be at 4 o'clock tomorrow on how to build a trading strategy on Bitcoin from scratch. That's going to be amazing if you get a chance to see that. But today he's going to be sharing with us basically the importance of investment into IT, and the title is Crypto as an Asset Class. So make some notes on this. Connect with this gentleman. He's the Chief Investment Officer of Creed and Bear. Put it together for Andrea Nardon.
Good afternoon, everyone. Sorry, I just need to adjust my voice. Can you hear me loud and clear? Perfect. So my name is Andrea Nardon. I'm Chief Investment Officer for Creed and Bear. Creed and Bear is a fintech company headquartered here in Dubai. We are very busy with many projects in the AI space applied to the financial sector. But one of the verticals of the company is a crypto hedge fund that we are about to launch. Today, I don't want to talk to you about the fund itself, but I'm relatively new to the crypto space, and every time I hear there is this dream of becoming billionaire overnight, but I think actually that the true important thing of crypto is really to start recognizing it as an emerging asset class. So we got about 15 minutes. I will leave some time for questions at the end. And I think I really want to try to show you how important it is to consider investment in crypto in your own portfolio. Now, I don't need to tell you what the case for crypto investing is. We're all here. We're all strong believers that it's going to fly. 2021, of course, we were dreaming. 2022 was very depressing. And 2023, from my point of view, has been really, really boring. Because if you look at the largest coins out there, they've been just moving sideways for the majority of the year. And for anyone like me that likes to trade, you do need movements. You don't need noise, but you need movements in the coins. Now, one of the most important thing for me is understanding how the gatekeepers for the asset class are. And right now, we're all talking about crypto exchanges. Yes, there are some futures that you can trade on the CME, but today, whenever you want to look at crypto, you're looking at the Binance of this world, and you try to gain exposure through them. But the reality is that the real gatekeepers of liquidity are the big banks. And as of today, there is not one single investment bank that is not somehow thinking to enter or to expand their presence in the crypto world. I just moved to Dubai. I was based in London and Europe. And last time I was in London, there is none of these banks, none of them were sort of shying away from their projects. Between London and New York, there is every one of these banks are working on offering services. That could be custody, could be trading, could be advisory, but they're all ready to enter and ride this new wave of crypto. Now, if the sell side, i.e. the big banks, are getting ready, the buy side is responding quite aggressively. I mean, here you have 3 of the 5 largest asset managers in the world. The top one, BlackRock, approaching $9.2 trillion of assets under management. And I'm very pleased to see the massive U-turn that they did. Larry Fink, just a few months ago, used some unrepeatable words talking about Bitcoin. And now their advisors are advising to put up to 5% into Bitcoin, into the digital asset. Now, for those of you that are not really familiar with asset allocation models, suggesting to put 5% is not really a little chip. It's not to say, hey, just put down 5% of your wealth into this, you may be doing well. So 5% is a very, very meaningful allocation. So for this reason, I believe really crypto is becoming an emerging asset class, and all the feelings, emotions we had so far dealing with the up and downs are precisely the same feelings we've been dealing with when we were investing in emerging markets or in smaller markets in Africa, for instance. So Crypto is becoming an asset class. So what does it mean for the asset allocation problem? Now, it doesn't matter if you are a wealth manager operating in the West Coast in the States or in Japan or in Australia. The 60-40 model is something that you're either using or you're benchmarked against. The 60-40 is a very old technique of managing wealth in liquid assets, consisting in putting 60% in equities, 40% in bonds, and then rebalancing that at different frequency, because obviously with the price of securities moving, the 60-40 ratio would sort of drift and move away. Now, we've done a very simple exercise. We've taken the 60-40 model, which is the blue line, and we've taken away 3%, only 3%, and allocated it to a passive tracker in Bitcoin. And look at the magnitude of that outperformance that you have over time. 3% of annualized improvement in your returns. This is staggering, but the most staggering thing is that even in 2022, when Bitcoin was very poor, you don't really see a deterioration of your performance. Now, this is not magic. This is called rebalancing. And whenever you have a lot of asset classes you're dealing with and there is little correlation between them, the more you rebalance, the more you tend to extract an alpha. There was William Sharpe that got a Nobel Prize in 1990 that published a paper that was mentioning the so-called rebalancing bonus. You put together asset classes with low correlation, and automatically through rebalancing you make money. So we've done our work, and we went out to check what is the correlation of Bitcoin with the other major asset classes. And you see that there is a slight positive, meaningless correlation with equities, but there is zero correlation with bonds. What does that mean? It means that if you are able to introduce digital into your portfolio, you are able, through rebalancing, to generate longer, higher, long-term risk-adjusted returns. But now, like every new asset class, you need to be very careful about the risks of this asset class. There are many things that you can use to assess how much risk you have in Bitcoin. I've taken 3 simple measures. I've looked at the standard deviation of historical returns, which tells you nothing else than how it fluctuates over day. Now, if you look at the riskiest equity index in the States, that's the Nasdaq. The Nasdaq has got a volatility of about 20%, which means that over a 1 calendar year at a 95% confidence level, you could be plus or minus 38% from where you start. Now, if you switch to Bitcoin, that figure goes up to 70%. So you can say that Bitcoin is 3 times riskier than the riskiest equity index. Then I've looked at the range, which is the second chart. It tells you how the price of an asset is fluctuating during the day. Now, equities fluctuate roughly 2% a day, which is a number that I think we can relate to what we see every day. Bitcoin has got around 6%, which means your entry point on any given day will determine if you make money or if you lose money. Now, the last way to look at, the third one, to look at risk, which I think is very useful to understand how can I access at best this asset class, is the distribution of returns. As you can see, Bitcoin, the red distribution, is very flat, which means you've got a lot of weight at the extremes of the distributions. Now, translating it from statistical terms, what does that mean? It means that if you decide to buy a tracker, well, you need to equip yourself with a lot of patience because you may have to digest very, very large drawdowns. If you buy a long-only product, well, then you may miss out on big opportunities on the short side. And so what we believe the best way to tackle this asset class is to have a directional long-short fund. And that is precisely what we have launched. We launched a Cayman fund that is trading Bitcoin and Ethereum using a variety of trading strategies, all built in-house. We are not high frequency by any stretch of imagination, but we do trade quite often, i.e. our turnover on a daily basis is around 50% of the NAV, so we are very active. And all these strategies are capable to stand up in their own feet, which means you are able to invest just in one of those. But we believe in diversification, and we think that if you're able to put multiple programs together, you're able to eliminate or reduce substantially your overall risk profile. It's a 24/7 market, therefore it's impossible to have human beings controlling the exposure to the fund. So we are fully automated, so we are embracing the wider concept of artificial intelligence. Everything is being coded by our developers that work in-house. We are cloud-based, and we have, I would say, a superior technology to what I've seen out there, because we managed to write an order management system capable to handle connectivities with multiple exchanges and handle the exposure of each individual strategy. So very quickly now, the last two slides, the investment approach is really anchored around the idea of diversification. We only trade in Bitcoin and Ethereum, which means we're not gaining a lot of diversification from coins, but we're using multiple modeling techniques to build a trading strategy. So diversification for us means having different models, different time windows, different parameters, and most importantly, different signals. And that's what we have built. There are 4 different types of drivers of performance in the fund. We got momentum, which obviously play a crucial role in crypto markets. We have one trend following strategy, although trend, I have to say, is not really present in crypto markets. The noise that you have and the volatility that you have somehow is overruling the quality of any trend following system, but we have one. We got breakout strategies, which are very successful in the very short term. And then possibly the most exciting strategy is pattern-based strategies, which means we're using a large number of machine learning models. And tomorrow afternoon at 4 o'clock, I will show you some examples of how you can build a trading strategy using machine learning, study from scratch. And these models are basically trying to identify a recurrent pattern in the inputs that we think have predictive power. And whenever we discover that, we just back them. Now, why do we believe so much in diversification? I think here I've taken a very beautiful example. On the left-hand side, you see 20 strategies that have been simulated with an expected Sharpe ratio of around 4, which means that in terms of risk-adjusted return, you have a very, very strong profile. Now, you can see that even if you have a Sharpe of 4, you may be disappointed by your own strategy. In this case, we are trying to deliver 25% per annum. The green line is our ideal return. And what you see is, on the left-hand side of this graph, that there are strategies that are below the green line. What does that mean? It means that you got, at the beginning of the year, a 5% probability of picking up the winner, but you can easily pick up the loser within this strategy. So the best way to tackle risk and uncertainty is to be diversified. So if you're equally weighting every day the outcome of those strategies, you get what you see here on the right-hand side. So we've been able to eliminate, in this example at least, risk just by simply investing in multiple strategies. So that's the end of my very short presentation. I think I managed to do it very well on time. We have a very big stand there in the middle of the hall. So if you want to come and talk to us about this, about tech, about whatever you want, feel free. We've got a very strong presence. Otherwise, if there are any questions in the audience, I'm very happy to take it. Thank you.
Thank you so much, Andrea Nardon. As mentioned, it will be on the block stage tomorrow, 4 o'clock, for a 45-minute presentation about how to do it from scratch, just in case you're wondering. Of course, for me, I'm an expert on it, but I might just be there just to write a few notes down just in case I missed anything.